Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about how to rebalance your portfolio for 2024. It is a new year. Happy New Year to everyone, by the way. We had a surprising 2023 in terms of market returns. I don't think anybody expected the stock markets to be up as much as they did. Bonds fell by quite a bit over the first 3 quarters and then rebounded in a big way once interest rates started creeping back down in Q4. I don't think anybody expected this after entering January with a really, really pessimistic view about the short-term outlook for stocks and bonds. Yet, we were wrong. So going into 2024, this is an opportunity as it is every year to rebalance your portfolio and think about whether your asset allocation is right for you. So I walk through exactly how to do this in this week's episode. We go through how we do this at our firm. We go through what you might consider if you're someone who does this on your own. And I give 2 methods here, both an easy way and a hard way for those of you who want to handle your portfolios yourselves. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the show, we're going to talk about how to rebalance your investment portfolios for 2024. And obviously, we're going into a new year. Happy New Year, everybody, by the way. And this is something that I think a lot of do-it-yourselfers out there know that they need to do and pay attention to it and do it kind of semi-regularly. But I also think that there's a lot of confusion around exactly, hey, how frequently should I really be looking at this stuff? Is once a year fine? Do I need to do it more frequently? How do I determine what to rebalance and when? I have all these different types of accounts. What kind of funds should I use? I just want to go through a sound methodology for all this in today's episode. We are obviously at our financial planning firm in the business of doing this on behalf of clients and have an elaborate method that we use and a lot of fancy software we pay a lot of money for every year to help support us in those efforts. And so what I'm going to do today is go through a couple things to think about in terms of rebalancing philosophy. And then I'm going to present 2 ways to rebalance your own accounts if you're out there handling your own investments and want to continue doing this on your own. One method will be the easy way. One method will be the hard way. And we'll talk about the pros and cons of both. So to get us started, the main reason that we care about rebalancing is because your investment portfolio hopefully is adequately diversified, meaning that you have some of your money in various types of investments with different risk return profiles. And there's a lot of mathematical support here for the fact that if you don't put all your eggs in one basket and you spread your investment risk out across multiple different securities, multiple different asset classes and types of investments, you can achieve the same long-term return and take a lot less risk, meaning that when the markets crash, you're not going to lose quite as much value temporarily, but over the long term, have the exact same outcome over maybe a 10, 20, 30-year period. So I think that concept is pretty well accepted at this point. We don't want to put all our eggs in one basket. We want to buy different types of investment, stocks, bonds, real estate, maybe some short-term cash in some situations. But at the end of the day, what will happen is if you have, and I'll use the most basic example, 60% stocks, 40% bonds in your portfolio, you take $100,000, if that's the size of your portfolio, you buy $60,000 worth of stocks, $40,000 worth of bonds. What happens on day 2? the value of the stocks go up and down, the value of the bonds go up and down. And what started as a portfolio balanced at 60% stocks, 40% bonds has now deviated from that somewhat based on market fluctuations. And we're just coming off a year where stocks did really, really well. All the stock indices were up, 15, 20, sometimes 20, some of them were up 22, 25%. Bonds were down substantially, maybe as much as 8, 10% in the first 3 quarters of the year. And then interest rates started coming back down here pretty aggressively in November and December. And now all the bond indices are up by 3 or 5% on the year. So they made up all that lost ground. Well, because the different asset classes, the types of stuff you're invested in are bouncing around and fluctuating so much, the portions of your portfolio are going to skew away from what your target is as well. And the whole reason that we have these asset allocations in the first place is because it lets you customize the risk in your portfolio for whatever it is that you're investing for. If you're investing to buy a new house in the next 2 or 3 years, probably shouldn't have very much of that in stocks. If anything, you probably want short-term cash products that will guarantee you a little bit of return without taking risk that the value of your holdings will be less than what you put in when it's time to buy that house. If you're saving for retirement and you're 45 years old, maybe you only have 15, 20, 25 years until your retirement. I say only. What I mean is you don't have the same risk profile. If the market crashes over that period of time, you have plenty of runway to earn it back before the time period when you need to rely on it. And that's when you give up your income and need to start paying for your expenses from your savings, which is the natural transition anytime we go into retirement. So I think of this as part of a strategic asset allocation where we're not rebalancing because, interest rates are a little lower than they were. I think that this sector is going to do well this year and that sector is not. So therefore, I'm going to make these short-term tactical changes with my portfolio. I am not a huge fan of that activity. I think that if you want to do that with a small portion of your portfolio, it's kind of like playing the ponies down at the racetrack. I could make an argument for why interest rates or the markets or any individual stock is going to go up versus down pretty much anytime I want. And I've been doing this long enough to where I could be relatively convincing, I think, on either side of those arguments. The fact is that we have absolutely no idea what's going to happen in the next 12 months. Think back to the beginning of January 2023. Nobody thought that it would be a strong year for the markets. The level of pessimism from all resources and outlets was exceptionally high. And then what happened? The situation in Ukraine got a lot worse. And I don't think anybody would have expected that interest rates would come back down and push bond prices up on the year, and that stock markets would be up, 20% on the year as a result of that. That nobody expected that. So to sit here this year and think that, I think this is going to happen for that reason, or that's going to happen for this reason, and to allocate your investment portfolio as a result of that, you are really, really playing with fire. There is not a human being alive that's done that successfully on a consistent basis for a long period of time. There are hundreds, thousands of people who made one of those calls right because there are hundreds of thousands of people making those calls. So inevitably, some of them are going to be right. But there is no human being alive that can do that consistently over and over and over again in a way that's going to produce better investment results. So I say that because our focus needs to be on strategic asset allocation first, and that's how much of your investment portfolio will be allocated to equities, stocks in the U.S., in other countries, big companies, small companies, how much will be allocated to bonds, how much will be allocated to real estate, other alternatives, venture capital, private equity, hedge funds, precious metals. We talked about that a couple weeks ago. If that's your thing, not my thing, but for some people, they feel differently about it. Whatever it is, that decision of what kind of stuff you're going to invest in is by far the biggest decision you're going to make, because it's going to have the biggest impact on long-term risk and return. So the first step in any rebalancing is reassessing your personal priorities. What does your own retirement plan look like? What are you earmarking this money that you are investing in and potentially rebalancing for? Is the asset allocation that you have and have been using still a good fit for where you are today and what you and your family really want out of these resources? That discussion has to happen. I'm a little biased here because I do this for a living, but it is exceptionally helpful to have a professional that you can go through this exercise with, particularly when you have a spouse. I don't know about you, but the financial conversations that I have with my wife, we do a good job managing our money, I think, but they're not always the most productive because we're married and there are relationship dynamics that come into play there. And sometimes having an objective professional to guide us through that exercise is just particularly helpful. So this is really the first step, regardless of how frequently you want to rebalance, regardless of your manner and mechanisms and so forth. Reassess your asset allocation based not just on your age, but what are you trying to do with this money? What is your time horizon? How much risk are you comfortable taking? And all the other relevant variables. And once you have that target asset allocation in place, either a revision from what you were using previously or a confirmation of what you were using previously, then it's time to think about rebalancing. Now, there are a couple schools of thought in how frequently one should rebalance in general. One of them is a time-based method. The other is a target-based method. We kind of use a combination of both here at our firm. The time-based method would be, I'm going to do it once a year. I'm going to do it once a quarter. And regardless of what happens over the 12 months of the year, I'm going to reassess my asset allocation and I'm going to review it compared to my target once a year, every January. And if my stock allocation has grown and my bond allocation has fallen as a proportion relative to my targets, then very simply, you probably want to sell some stocks, use the cash to buy bonds, and bring your portfolio back to that target asset allocation you're looking for. So periodic is one way. If you're doing this on your own, you probably don't need to go as frequently as quarterly. I would probably say, every 6 to 12 months is fine. There are going to be times when your portfolio skews and falls astray from those allocations that you're targeting in between the time periods in which you rebalance. But as long as you look at it every single year, you're probably not going to take too much risk by doing that. The reason that we want to rebalance in the first place, by the way, is inevitably equities over long periods of time are going to outgrow bonds because they're riskier animals. Over the short term, they might lose money, right? This is just one of those things where if you spread it out over a longer period of time, stocks are just going to do better than bonds because that's a required return by investors for the amount of risk that they're taking. And so if you never rebalance, the portion of your portfolio in stocks is going to grow higher, 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 and the portion in bonds is going to fall. Not because the bonds are necessarily going to lose money, because the stocks are going to grow faster and outpace the bonds. And so what that means is, if you're someone who's going to retire in 20 years and you have a certain risk profile, let's say it's 80% stocks, 20% bonds right now, if you never rebalance, 5 years from now, you might find yourself in a position where 90% of your accounts are in stocks and 10% are in bonds. But your time horizon has gotten a little shorter. You might not be comfortable taking as much risk as you did initially, and you should probably have a more conservative profile at this point. But your portfolio is going in the other direction because that's naturally what tends to happen. So one way to look at this is just do it once a year, twice a year, something like that. Another way to do it is to review it based on targets. and you might have like 5% tolerance bands is one way to do it. If you're at 80-20, 80% stocks, 20% bonds, you might have some mechanism, some tool that will alert you if the portfolio deviates by more than 5%. So if your stocks grow to the point where they exceed 85% of your portfolio or fall below 75% of your portfolio, you'll get some kind of alert. That's a target band manner of rebalancing. What we do here at the firm, because we have, again, a lot of fancy technology to help us manage this stuff, we look at everything once a quarter or more frequently. So we look at all our clients' accounts quarterly, and if there's a huge move in the markets, then we'll potentially rebalance and look at them more frequently than that. Part of the reason there is markets tend to mean revert over time. And so if you have a time frame where the markets fall the stock market falls by 10%, it's going to tend to bounce back. And so if you're at 80% stocks, 20% bonds, the stock market falls by 10%, and the portion of your stocks as a result have fallen, it makes sense to rebalance, sell some bonds, use the cash, buy stocks. Because, again, stock markets tend to mean revert and bounce back. And if we don't rebalance during that time, the portion of our equities that catch that bounce off the bottom are going to benefit, but not by as much had we rebalanced exactly at the bottom and bought some more stocks. So this is not us, trying to time the market and figure out when do we need to put more money in stocks. It's more, let's keep a consistent risk profile throughout. And if we deviate by too much, then we need to rebalance. So we do a periodic thing. If the markets move substantially, we take a look at it in the middle of the quarter, and then we use target bands to alert us when we need to rebalance and when we don't. Now, those are a couple high-level thoughts. For your intents and purposes, for your do-it-yourselfers out there, there is an easy way to do this, and there's a hard way to do this. The easy way is to arrive at your target allocation and then rebalance all your accounts pursuant to that target. And for most retirement savers in the US these days, they have a mix of accounts. You might have a 401k at work, which you can choose certain models or target date funds or mutual funds or whatever within. You might have a taxable investment account. You might have a Roth IRA or a traditional IRA, something like that. Most people have a mix of different accounts that they accumulate over time. And the easy way to do this is to say, hey, we're comfortable with 80-20. Maybe of that 80%, we're going to allocate a couple percent to investment real estate, maybe a couple percent to commodities like oil and natural gas, those types of things. And we're going to replicate that allocation across all our accounts. So you log into your 401k, you set your investment elections to that exact portion, and then you move on to your taxable accounts and you rebalance in your taxable account, and then you to 80-20, and then in your IRA and traditional Roth IRA, you rebalance those to 80-20, and you use similar securities, mutual funds, ETFs, whatever, across all the accounts. That's the easy way to do it. The hard way to do it does have benefit, but it's not going to move mountains for you. It includes the incorporation of strategic asset location. This is something that our software really, really helps us with. And the reason that we do that is because all those types of accounts that we just went over have different tax ramifications. Your 401k, assuming that it's in traditional tax-deferred money, is not taxable when you rebalance. You don't pay any gains or tax on gains or dividends. You can sell, you can buy with impunity, no tax ramification. Every dollar that comes out of the account when you start to distribute money is taxable down the road. That's the exact opposite of your Roth accounts, maybe Roth 401k, Roth IRA. The Roth accounts you've already paid tax on All the growth is tax deferred, dividends, distributions, capital gains, so forth, tax deferred. But then when you take money out later on, you're not paying tax on those distributions. The money that you have in taxable brokerage accounts are taxable every single year. And so what tends to happen there is the money that you have in taxable brokerage accounts, you purchase investments, they grow over time, but then you're somewhat reluctant to sell and rebalance because you might have a long-term capital gain that you don't want to trigger. On top of that, different asset classes that we invest in have different tax ramifications. Bonds pay you interest that's taxable at your ordinary income rate. Stocks tend to pay dividends and capital gains that are often taxed at lower rates. So the hard way to do this is to incorporate strategic asset location and park the least efficient asset classes that are going to grow by the most and produce the longest term, the biggest capital gains in the Roth accounts first. And park your bonds in the tax deferred accounts that are not going to grow by as much, that'll produce interest that's taxable at your ordinary income rate. And because they're not going to grow by as much, that means that when you distribute them from your 401k IRA down the road, which you'll have to do, remember we have these mandatory distributions from those accounts, though they won't have grown by as much and therefore have a smaller impact on taxable income. So the way to do this is, just like with the easy way, start with your strategic asset allocation, figure out what your targets are, either confirm last year's or make adjustments. Then start with your 401ks and taxable accounts, because the 401ks are probably where you have a limited menu of investments to choose from. Your taxable accounts, because you probably have positions in there that you do not want to sell because you don't want to trigger capital gains, and view those as part of, the anchors of your asset allocation. And then with the other accounts, use the balances in those accounts to reach your target portfolio, and try to park, again, the least efficient asset classes in the Roth accounts, the high growth ones in the Roth accounts, the low growth ones in the tax deferred accounts. There have been a lot of studies around this, and last good one that I saw says that if you do this successfully, consistently over a long period of time, you're probably adding 0.25 to 0.35% after-tax returns to your portfolio every year. Some years are going to be greater than that. Some years are going to be less than that. I can tell you, having done this on spreadsheets before, that it gets really complex really quickly. And I've seen a lot of people screw this up over the years, not implementing it successfully. So just bear in mind, if you want to go the hard way, make sure that you're in for a continued commitment and continued efforts. Because if you get into it, you're making potentially long-term decisions when you put investment dollars to work in a taxable account. You might be reluctant to sell those positions when they grow in value over time. And for that reason, don't tread into this lightly. You're not, like I said, the asset location is not really going to move mountains for you long-term. And if you're not sure about it, just start with the easy way, because you're far less likely to mess it up. Now, the other thing that I wanted to mention as far as rebalancing for 2024, there are far more exchange-traded funds available on the market today than there ever have been in the past. We've had index ETFs and mutual funds around for a long time. We've had other ETFs and mutual funds with a similar methodology, but simply different way of weighting the holdings that have been around for a long time now. I'm talking about Dimensional Fund Advisors and Rob Arnott's method of fundamental valuation. Those are all really, really sound ways to invest, I think, that hardly cost any. They cost a little bit more than your core index funds, but they're a far cry away from actively managed funds, and I think are really an improvement on traditional cap-weighted indexing. There's just a huge amount of ETFs available these days, And because of their structure, ETFs are just a little bit more tax efficient than mutual funds. And for a lot of people, they're easier to trade too. So as part of this 2024 rebalancing, you come up with your strategic asset allocation. Then you figure out whether you're going to take the easy way or the hard way. And then you sell some securities and use the cash to buy other securities to bring your accounts back into your target balance. As part of that, you might want to use this as an opportunity to use more ETFs than mutual funds. Because, like I said, ETFs are a little bit more tax efficient. The world is getting away from mutual funds. One of the drawbacks of ETFs, and that's trading volume and implicit cost, bid-ask spreads, and the possibility of the underlying holdings deviating from the over-the-counter value of the fund. Those are still minor concerns today, but because there's so much more volume being traded in ETFs these days, they're far lower concerns and really not an issue that I personally I'm concerned about. And at this point, we use ETFs in most of our clients' portfolios. So as part of this process, if you're someone who's historically used mutual funds, you might think about swapping over to ETFs. If you're only in tax-advantaged accounts, IRAs, Roth IRAs, 401ks, it's really not going to make that much of a difference. But in your taxable accounts, I'd really want to look hard at ETFs because there are just far fewer situations where an ETF has to distribute those year-end capital gains to you that you get to pay tax on in a taxable account in your name, jointly with you and a spouse, in the name of your revocable trust, something like that. So these are all considerations for 2024. And whereas a couple years ago, the volumes of ETFs were not as high, meaning that fewer shares were being traded every day, there was more opportunity for greater costs from bid-ask spreads and the underlying fundamentals changing, kind of shifting underneath your feet. That is far less of an issue today because volumes are simply so much higher. So that's it for today. I hope this was helpful. Wish everybody a happy new year. This is a really good time of year to look at your portfolio and make some of these decisions. We went over the easy way. We went over the hard way. As long as you're looking at this at least once a year, I think you're probably going to be fine. There is some added benefit to rebalancing a little bit more frequently than that. But the details, the details depend on your own situation, like everything else. All right. Talk to you all again soon. Hope you enjoyed it.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.